Greetings, people. Mr. President here. We're back with another one. So, today we're doing grade 10 accounting equation. And from the lower grades, we're obviously taught that your accounting equation is simply your A equals your OE plus your liabilities. So, what you should understand is that your A, it stands for assets. So assets are all the possessions that we own or individuals could own. It could even be businesses. So in this case, it's going to be businesses because we are dealing with a business, but a business of a sole trader. Then when it comes to your OE, that stands for your owner's equity. So by owner's equity, we simply mean that whatever capital or whatever amount of money that we decide to invest into the business so that the business can remain running now and then again. Then for your L, it's your liabilities. Liabilities, these are the debts of the business. So it's either your debts are going to be long term or short term. Hence, for liabilities, when we're going to be entering your term 3 topic, which it's going to be about your balance sheet, your income statement, your fixed asset note, and all these other notes, you will now learn that we have two main types of liabilities, which is your non-current liability, and that is your long term, and your current liabilities, which is your short term. Right, without wasting any further time and explaining all these things, you will see them on my next videos upcoming. Right, let us begin. So we're going to first begin with our column A and column B. So you can skip this part if it's not that important to you, but I feel it is important to complete. So with this one, can be quite easy. Yeah, that's all I could say. So 1.1 is speaking about business entity, and by the look of things, I can already spot that F is my answer there because they said financial affairs of the business are kept entirely separate from the financial affairs of the business. Of the owners. So F is the one that is going to affect your 1.1.1. Then your 1.1.2 historical cost. So for historical cost, of course, C, all assets are recorded at the cost price. So C, it's the answer there. Then matching principle, that's your A. Income and expenses must be reflected against each other in the same financial period, of course. And this, it mostly applies when it comes to your income statement. Yeah, that's all I could say for now. Right, and then 1.1.4, going concern, of course, that is going to be our D because they're saying to us financial information prepared with understanding that the business will continue in the future. Of course, like it's an ongoing thing, going concern. So it's a concern that has to go on now and then. So it's not just a present concern, it has to be a present and a future concern. Hence, they saying going concern. And it's a concern that takes place even in the future. And then when it comes to prudence, of course, that is going to be B right there. Because with B, they saying to us, financial information recorded in a constructive what? Manner. And B is our beautiful answer there. Right. So after that, we get straight into business now. So the business that I'm talking about, of course, is the accounting equation. So with the accounting equation, we should be very, 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 very careful. So here are a few steps that I want you to use whenever you're dealing with your accounting equation. So step number 1, you must check if whether it's an asset. You must check if whether it's going to affect your asset, your owner's equity, or your liability. The second step, you check if whether does it increase or decrease your asset, owner's equity, or your liabilities. Then the last step, of course, you just have to record your transactions. Right. So now with these 3 steps here, let us quickly, use them to tackle our three beautiful questions there. So they said we received 600, okay, from April, a data in payment of his account. So now, let us check. We are receiving and it's cash, right? And whatever that is cash, it's going straight to the bank. Perfect. Now you ask yourself, do we own the bank of the business? Yes, we do own a bank. And I said, what is an asset? It's any possession that we own. So bank, it is an asset. And then now, when it comes to April, they said this person is a debtor. So if he's a debtor, then it means this is going to be your debtor's control. Perfect. Then now you check. Debtor's control. Do these people own me or do I own them? Well, I own them because they owe me. They have what is of me, but on credit, right? So if it's on credit and whatever that they took from me was on credit, rather, this declares me the right to say I own them because at the end of the day, they have to make a payment back to me. So meaning for debtor's control, that's an asset. So now the first step, it has been checked out. So we now understand that, okay, bank is an asset, debtor is an asset, right? Then now we have to check, does it increase or decrease your asset or your owner's equity, right? Now, with your bank, money's coming into the business. So if money's coming into the business, do we minus that money or do we increase that money? Of course, it's going to increase. So via the cash pot, our money is increasing. But when it comes to debtor's control, this person is paying off his account. So the money that he used to owe us, he won't owe us no more. Hence, for debtor's control, it's going to be a beautiful minus. Now, we have to record, but when you record, you must be very, very careful. So one thing you should understand is that your assets, they increase on the debit side and they decrease on the credit side. So your bank, it's going to increase. So that's an account that is going to be debited. For your debtor's control, you are losing a debtor because he's making payment. So hence it's going to go straight to the credit side. So the account debited, it's bank, and the account credited, is creditors, is debtor's control. Sorry for that. And by the look of things, it was already recorded for us. So the only part that is left for us to record, it is the bank part. Then what was the amount? The amount was a 600. Beautiful. Then after a 600, we now understand, okay, bank, it's being debited, so it's on the plus side. So hence, when we come to an asset, it's going to be a plus. Then your debtor's control, don't forget, it's also an asset. So by an asset, it's going to be credited because you are losing your debtors. So it's going to be a plus minus. Then for owner's equity, it's not going to affect. For liabilities, it's not going to affect. So just like that, you're done with the first transaction. Now with the second transaction, we're going to also have to look straight into it. So they sent to us donated goods. Oh, apologies for that. Donated goods. So by goods, it means this thing is going to affect your trading stock. So whatever that is goods to the business, we are simply saying a trading stock. So they said to us, we donated. So by donated, it means these are donations, right? So already we've identified the two accounts that are going to be affected, which is your trading stock and your donations. And they said to an orphanage amounting to how much? 5,000. Perfect. So now we have donations, we have stock. So now what is stock? Stock is something that we own, right? And what we own, it's a possession to us. And that is, of course, your asset. So when it comes to your donations, they affect your owner's equity because now it means from when we will be doing especially your balance sheet together with your income statement, I think this is when you would get a deeper insight on why donations are going to be affecting your owner's equity. So in that part, I don't want to be a spoiler because I'll be teaching that very soon. So if you stick with me, you will understand this way more deeper than anything else. So with donations, you should just understand that it's going to affect your owner's equity. I'm going to give deeper insights as we go with time on why does it affect owner's equity. So right, one thing you should understand, donations will always affect owner's equity in a negative way. So meaning they will always decrease owner's equity, right? So already donations, we are going to minus owner's equity. Your asset, which is your trading stock, they're going to be minus because we are taking the goods of the business, we are giving them. So do we have them with us? Of course not. They are with the orphanage which we have donated to. So now you write your two beautiful T accounts because now you have an owner's equity that is going to be affected. You also have an asset that is going to be affected. Debit plus, credit minus. Debit minus, credit plus. Perfect. Now, on which side does your asset decrease? Of course, on the credit side. So meaning trading stock, it's going to be credited because your stock is leaving the business. Then now, for donations, how do they affect owner's equity? They decrease owner's equity. So by owner's equity, where does it decrease your owner's equity when it comes to donations? On the debit side, of course. So the account that is going to be debited is your donations, and the account that is going to be credited is your trading stock. Perfect. And by the look of things, it was already written down there for us. Then which account is going to be credited? Of course, it's your trading stock. So I don't have enough space there, hence I'm writing T stock. But in your exam, always write the full word or words. Perfect. And then the amount they said to us, it's a 5,000. So what's happening to your asset? It's decreasing. So that is going to be a minus. Then what's happening to your owner's equity? It's decreasing. And then it's going to be a minus. Your liabilities, of course, they're not going to be affected. And by the look of things, your accounting equation, it's balancing. Remember, when something is an equation, it means the left-hand side, it should equal the right-hand side. So whatever you decide to increase in your assets, you must ensure that you increase it in your owner's equity together with your liabilities. And if you decide to decrease your assets, you should consider also decreasing your owner's equity or your liabilities. Or you have to do both this side so that by doing both, you would get a 0 and a 0. So let's try it with the first amount. So we have a plus 600 and a minus 600 to our assets. And from the owner's equity to 0 plus a 0, of course. Then a 0 plus a 0, 0. My plus 600 minus 600, 0. So now you can see that all your transactions or your amounts, they are rather, or your equation, it's now balancing. So everything is smooth and perfect. Now with transaction number 3, 1.2.3, it says to us, we sold. I want you to listen carefully on this one. We sold goods. So meaning we made sales. But on cash, 30,000 of course. The business applies a 50% markup policy. So on this one, like people, you must just understand that there's going to be 4 accounts that affect this kind of a transaction. So whenever it's sold, then you must know that, okay, there is sales, right? But then how did we sell? Did we sell on cash or did we sell on credit? And once you see sales, you must now think of your cost of sales. And of course, when you see your cost of sales, you must now automatically think about your trading stock. So this is how you should look at the structure of this kind of a transaction. You first check, yes, it's sales, but how did I sell? Did I sell on cash or did I sell on credit? Those are 2 things that you must consider. Now, because we have sales, of course, I must now get the cost of the very same sales. And once I see my cost of sales, it means now my trading stock, it's leaving the business. Perfect. Now, if it's cash, you must know it's going to affect your bank because Mula is coming to the business. Now, when it comes to your credit, what should you think about? Of course, man, debtors control. Because you're selling to people, so now you're gaining debtors. So you own those people, right? So one thing you should understand, your sales, it must always be in part or added with your markup together with your cash or your credit transaction that takes place whenever you sell these things. It must also include a markup. But with these ones, no markup must be included. No markup must be included. Nothing. Great. So now, for the first part, they told us we sold goods. On what? On cash. So meaning sales are taking place, right? So we identify the accounts that we have for now. So we have sales, right? Sales, what does it affect? Your sales are going to affect the owner's equity. And I'm still going to explain on the video how does it affect owner's equity. Well, we can express that via our income statement. So when I release a video on income statement, please check in that video. So your owner's equity, it's going to be increased because money is coming into the business, of course. Then now, cash. Of course, when it's cash, I told you it's what? It's bank. And by bank, this is an asset. And money is coming into the business, so it's going to be a plus, of course. Now, when it comes to your cost of sales, they also affect your owner's equity, but in a negative way. I will explain people again. Now, when it comes to your trading stock, it also still is an asset, right? But are you gaining the stock? No, I just sold the stock. So the stock left the business. So hence the stock is going to what? Decrease. Then it means these two are going to travel together, and so does these other two. Perfect. Then you draw your two beautiful T accounts. Now we have owner's equity. We also have an asset, debit plus, credit minus, right? Credit plus, debit minus. Then we start with sales. So sales is going to affect owner's equity. It's increasing, but on which side does it increase? On the credit side. Then when it comes to bank, what's happening? It's also increasing. It's an asset, but it's going to affect an asset. On which side does your bank increase? On the debit side. So meaning for these two beautiful friends there, bank is going to be debited and sales is going to be credited. So let us quickly record that. So bank is going to be debited, right? And sales is going to be credited. What's the amount? They told us that it's 30,000. Beautiful. Just like that. What's happening to your bank via your assets? Increase. What's happening to your owner's equity? Increase. What about liabilities? Of course, that's a zero. Now, for cost of sales, remember I said it doesn't include a markup, right? And with the 30,000, that shandies, it includes your markup of the 50%. So this is what we have. So don't forget the formula. Given times what you want over what you have. Perfect. So what will be given? We'll be given the 30,000. What do we want? We want 100 alone. So hence 100 is going to remain upstairs. Then what's going downstairs? What we have, which is 100 plus the 150 plus the 50, which is equals to the 150. So you're going to say 30,000 times 100 over 150. Instantly, you will get your 20,000. So this is the cost of sales. Then now you check again. Cost of sales affects owner's equity. On which side does your owner's equity decrease? On the debit side. So the account that is going to be debited, it's cost of sales. What about the account that is going to be credit? Okay, I gave you an answer, sorry. So with your trading stock, it's decreasing. So once it's decreasing, of course, it's going to be credited. So that is going to be trading stock on the credit side. account debited cost of sales, account credited trading stock. Perfect. Then account that is going to be debited cost of sales, and the account that is going to be credited, that's your trading stock. And the amount we just calculated, that is a 20,000, right? And then when it comes to an asset, don't forget you're losing the stock, right? So hence on asset it's going to be a minus. Then cost of sales, I said it affects the owner's equity in a negative way. Hence via the owner's equity, it's going to be a minus. What about your liabilities? Zero, because it's not going to be affected. So thank you, ladies and gentlemen, for staying up with me up until this time. May the good Lord bless you. President to the world.